Welcome to the Leafy podcast, helping real estate investors and entrepreneurs grow. Say hello to your hosts, Jennifer Glagoric and Brian Price, founders of Leafy Legal Services, teaching you how to protect your assets, grow your business, and manage your wealth. Let's start the show.
Hey, everybody, with Leafy podcast, people that are out there today. Tammy won't be with us, so you will notice that the intro is not nearly as smooth as it normally is because I'm doing it now. So anyway, welcome to the show. This show is going to be awesome. It's going to be Brian and I, and then we have someone on the show that has over a decade worth of experience in real estate. So we always love our REI peeps and engineering management and overseeing management, in over $1 billion plus worth of real estate assets. On top of having this incredible background and career, which you're going to hear more about, she also is a passionate volunteer with charities. Even working with Hurricane Harvey victims, which of course affected yours truly here. So we're going to talk maybe a little bit about that if we have time. So let us welcome the wonderful Veena Jetti here to the show, and she's with theorypmr.com. So we're going to find out more about that. Hey, Veena.
Awesome.
Hi, everybody. Thank you for having me. Thank you.
Well, yeah, let's get started because we were talking, and I know you have a couple companies, but this new one, Theory Property Management, is something that just came out, as I understand. Is that correct?
Yes, we just rolled out. It's a vertical of my initial baby, which is Enzo Multifamily.
Right. So why don't you give us a little bit of history maybe on yourself and then how it kind of came from Enzo and then what Theory is all about that you're starting now?
Yeah, so I come from a real estate family. My parents have been investing in real estate ever since I was born, maybe even, I actually don't know what year, but about 35 years. They've been investing in real estate. And so I grew up around this. They started with a single family home model, have been very successful in it. Both of them retired early and then unretired because I've hired them into my companies now. So, but they've done really well for themselves based on real estate investing. And so my husband and I, our first year married, we had paid a ridiculous amount in taxes because I was working for Tishman Speyer at the time, which is, a corporate real estate firm based out of DC. I was based out of DC. And after working there and then paying our first joint tax bill, we were like, wait a second, this is a lot of money to be spending on taxes. And so, I kind of went to my parents, asked them, how did you guys do this? And, what were the benefits? And, I'm sure many of your listeners are interested in real estate for the tax advantages that real estate offers. And so my husband and I decided that it was time for me to kind of make the leap and start investing into our own portfolio and managing that full time. I started with single family homes like most people probably do. I did the fix and flips. I did the buy, rehab, and hold. And eventually it just came to a point where it just was not a very scalable model. So around that time, I had met my other founding partner, my co-founding partner of Enzo Multifamily. His name is Stephen Talati. And him and I came together and we just had a very synergistic personality. He had a lot of strengths that I didn't have and vice versa. So we said, okay, let's leap and let's see how this works out. And so today, Enzo Multifamily still operates. We have maybe around $300 million in our portfolio currently. And in that, one of the things that we've learned over the years operating assets is nobody looks after your money the way you look after it. And with property management, I come from a management background. And so with that, one of the biggest challenges that we found with multifamily specifically is that there's not a whole lot of cutting edge technology that's incorporated into the property management model. It's like a very rinse and repeat model that's basically been the same for decades. So my partners at Theory and I, there's 6 of us. It's my co-founding partner, Stefan Talati, Pooja Talati, who is also a partner at Enzo, and then Rohan Johar, who is our COO and one of our managing partners, Jay Haynes and Jared Watson. So the 6 of us are all very diverse team, and we all bring a certain strength to this property management model, which I don't see in other companies that we've worked with to date. So, not to say anything bad about them. I just think that there's a better way to do it. And we've already started implementing some of those tech-forward processes, which we've seen a massive change in our portfolio from doing that in and of itself.
Do you mind getting into some of the tech stuff that you're doing?
Sure.
Yeah, I'm so curious about it.
Yeah. I'm a tech guy myself, so I always like to hear that kind of thing.
Oh gosh, I know enough to be dangerous. So really who you want to talk to getting down and dirty is my partners, Rohan and Sep, and they're the ones that run the tech side. But from a high level, an example of one of the things that we're building out is the biggest challenge that we've seen in Enzo on our property management, our third-party property management, is that we don't have enough real-time data. So we're not able to make decisions with the best available data, right this second. We have to wait for a whole feedback loop to come back to us. And that can take hours, days, weeks even, sometimes depending on the information we're trying to find. So we're building out processes, and we built out systems, proprietary systems, that now allow us to make pivots and make decisions based on real-time data, real-time occupancy, real-time revenue, real-time ROI, and all of that changes from day to day across properties. So I understand why most companies don't do this, because it's very difficult to have that volume of information. You need to slice it so that it is digestible at a very quick read. So now when I log into, for example, we have a property called the Bentley that we closed on in June. When I log into that dashboard, I can immediately see, okay, valet trash is working here. Valet trash can be $10 higher here. We can test it on these 10 units that I know are coming up. We can take 17 short-term leases over the next 5 months. So there's all these little data points that allow us to manage better and make pivots quicker. And I think having that quickness in data and that real-time data is actually going to be what sets Theory apart from other companies.
Boy, that is fascinating, because when you think, everything is getting a lot more data driven, and some people are afraid of that. When they hear data, they're like, you're taking the people out of that. But real data is not taking the people out of it. What it's adding is the people in there, like an expert, if you know what the data you're looking at, and then you understand the ROI for it. So let's say valet trash. Well, that's a really great amenity, and it's better if you have people who are senior citizens, if you have accessibility units where that's going to be kind of needed, or, depending on, or more upscale types of tenants. Some places, that's not going to add a lot of value. They're all young, they don't care, they go take a trash, they see people, they feel like they're in a very safe neighborhood. Sometimes valet trash, depending on your block, is good, but you kind of are bordering places that maybe aren't. Maybe adding valet trash makes people feel a little bit safer. So all of these things take a lot of human input for that. So I think that's fascinating.
Yeah, I mean, I think of it like the internet, right? The internet can provide you with, if you think of a doctor, for example, right? I WebMD stuff all the time, which drives my physician husband nuts, by the way, but I do it. And I'm like that patient. I walk in with a stack of all of my potential diagnoses, and my husband's like, oh my gosh, I don't know her, please. I don't know her. But anyway, so, it's a tool, right? I can educate myself. I can have more information to make better decisions. So now I can take that and go to somebody who actually does know how to implement these, or who can execute these things. So it doesn't replace humans as much as I think it gives us a better ability to operate in a stronger capacity. But it's a tool, just like anything else.
Yeah. Brian, you were typing, so I muted you. So.
Oh, no problem. Yeah.
So anyway, that's interesting. So how do you feel having that technology helps you in scaling? Because you said one of the reasons that you left fix and flips and buy and holds was you didn't feel like it was more scalable. How do you feel multifamily along with this technology allows you to be, or allows any investor to be, more scalable?
Yeah, so I think one of the interesting byproducts of being very data-driven is that it allows us to underwrite better. And so it allows our modeling to be a lot tighter at the get-go. So we can sift through properties a lot quicker as they're coming across our plate. So where maybe a year ago it would have taken us X amount of time to underwrite 100 properties. Now we can underwrite like 130 in that same amount of time, or 150 in that same amount of time. And that's because we're no longer going out and fact-finding data points. So for example, I'll stick with valet trash, right? Some of our properties cannot sustain a $25 valet trash charge, but they can sustain a $20 valet trash charge. Some of our properties can do a $30 charge. It just depends on the neighborhood, the metrics, the demographics. Like you said, there's a lot of different angles that you have to consider when you're implementing new amenities like this. And so being able to have a global comprehensive view across multiple properties and multiple portfolios, it puts us in a position to be able to make underwriting decisions faster and our modeling to get better. So that's how we scale quickly from a multifamily perspective. Now, for anybody who's looking to go into single family, or maybe moving from single family to multifamily, I mean, I think the answer is kind of obvious on how you can scale there, right? Like you buy one property and you can have 100, 200, 500 units, whereas with single family, you're trying to manage one unit at a time, which is a great model. It's a great model to get started. Like I said, my family background started in single family. So it's a great model to get started, but I think knowing what I know today, people always ask me, what's the one thing you would do differently? Knowing what I know today, I would have started with multifamily and completely skipped single family.
That's pretty interesting. And I've heard that from more than one multifamily person. Multifamily, they y'all tend to be like, the old-fashioned Saturn owners. There are no other cars but Saturn. And I guess
that was my first car. I had Saturn as my first car. So.
Well, there you go. You find
but they're built by robots, though, right? So they must be great. Oh, wait, they went out of business.
But people love them. They love
the
Saturns, right? Like people with Tesla. The people who get Tesla, generally, they're just like so into
my other car.
That's hilarious. That just is your
You're
bike.
Like nailing me right out. Yeah.
That's great. Okay, so if you're looking at, so that comes to my next question. So you're a new investor. You are just now on Bigger Pockets or Connected Investors. You're like, how do I get some skin in this game?
Yeah.
You're like, okay, I can use hard money. How do I, you're just overwhelmed. It's overwhelming.
Yeah.
So why would they consider multifamily? How hard is it to get in? What do they need to have cash wise to get into it? And what do you guys look at? Those are a lot of different questions, but there are a lot of different questions. Somebody to come to you guys.
Yeah.
How would you do that?
It's so funny because I don't actually convince anybody to do this ever. I think our passion kind of just speaks for itself. And honestly, it's not going to be the right investment vehicle for everybody. We have a massive database of investors. We overfund every single one of our deals, and very quickly at that. So I turn away money more often than I would like to, but it's just, the nature of our deals, they fill up quickly. So I think if someone wants to get started, the first question I get is, do you have to have a ton of cash to do this? And no, you don't, right? Like that's the beauty of syndication within a multifamily space. We do 506B raises typically, where you have friends and family or pre-existing relationships that can invest into your deals once you have them under contract. So I think that the best way to get invested into multifamily is to start as a syndication partner of someone who is experienced, who has done this before. We frequently will bring on investors to work with us. One of our JV partners, Veena Jetti from O'Neill, he actually has like an academy that he runs, and he will occasionally allow students to invest into his deals and kind of learn the business from rolling up their sleeves and getting involved. So they often will be a part of Enzo's deals as well. So I think that those are really good avenues to get started, especially because it's not impossible, but it's very difficult to just, jump off that cliff and you can't get approved for funding, you can't get approved for, your property management. So there's a lot of different pieces that Fannie and Freddie are going to require approval on, or even a CMBS lender or a bridge lender will require from you. So I think the first thing is to find someone that you can partner with who has experience, who can bring the track record, who can bring the resume, and who can teach you how they're doing and what they're doing. So no, you don't need thousands of dollars to do this, but it doesn't hurt, but it definitely is not a requirement. It's not a barrier to entry, so to speak. It's just you'll need to find a way to add value. So one of the ways one of Vinny's students has added value to our Project Bentley that I mentioned earlier is he lives in Orlando where the asset's located, and he went and he did all of our unit walks. So when we do due diligence, we always walk all of our units, and he actually came and took notes while partners or our GCs were walking the units. So it's seemingly, not a big deal for him to be writing on an iPad and checking down our checklist of on our tech forms or whatever. But it is helpful because it allowed us to free up one of our admins to go focus on something else who would normally have been doing this. So things like that are ways you can get in and add value to an experienced sponsor. What were your other questions? I've lost track of all of them. Did I answer them?
No, you pretty much answered it, because most people want to know, well, how much do I need to get started? That's the first question that I get when people, well, how much money are we talking about? How do you get started? And so you just answered it. Really, it varies. It depends on what you can bring to the table and who you know on it. It's getting out there. Real estate investing is not like other things. You've got to know people. You have to network, and you have to know and trust them, and they've got to feel the same way about you. So if you're good at doing that, it's good. It's good, but it's still work. There's no way I've seen where anyone's actually made real money where they just threw money at the problem and walked away. I've never seen anyone
I wish
do that. Yeah,
that would be so much easier.
I know, wouldn't it? Just here. I was able to scrounge this up through all my bed cushions and take it and just and now I'm typing on a beach. Yeah, that's what I do.
I wish that would be the life. If you figure out how to do that, let me know.
Okay, I will definitely try to let you know on that.
You'll finally sell the course on how to actually do that versus all the other ones that say it. Well, great. So what else would someone need to do when they're getting started? I know a lot of our listeners are looking at that when it comes to that. So a lot of it is sweat equity, looking at someone to partner with. What should someone be doing due diligence on that? Someone that, that they're looking to partner with and as they're networking.
Yeah, I think that's a good question because there are a lot of programs out there. Some of them I don't know personally, how meaty they are, so to speak. There's some cheaper resources available. I personally am of the opinion that if you're going to spend $50,000 on a course, you might as well invest that passively and then see how the deal works from the passive side. That's also because I don't have a $50,000 course to sell you. So it's a lot easier for me to say that, I think, than somebody else who does have that course. Now, some of the things that I like, the reason I like Vinny's program so much, there's another program I really like, which is Jonathan Twombly's multifamily investor community. He has a great Facebook group too. And, a lot of us are on there and I help answer questions as much as possible. So I try to be a resource for other people that are coming up behind us in this. But the reason I like those two specific academies is because they're very rich in content, but the price point is much lower compared to what I'm seeing with other investor gurus. And I don't know all the programs out there. This is just the ones that I am familiar with or know. And I know both Jonathan and Vinny very well. I know their models. I know how they underwrite. I know how they consider all the aspects of their deals. I know what they teach, and I'm very much in agreement with those things. So that's why I like those programs. There's certainly plenty of other resources. Bigger Pockets, like you mentioned earlier, Jennifer, is a free resource. There's a lot of noise on it, so it can be overwhelming and intimidating to kind of cut through the fat and kind of figure out what you actually need to be doing there. But I think honestly, I'm very active in our Facebook groups that I'm a part of. I'm not as active on Bigger Pockets because of all the noise, but I think that you can reach out. Most syndicators will, or most like experienced syndicators will be happy to meet with you, even if it's for 30 minutes or 60 minutes via a Zoom call like this, and help answer questions. I've never had an instance where I can't get somebody to just help me, like, hey, I'm looking at this property. What do you think of this? And so I think it's like a very community feel. At Enzo, we really believe in the collaboration, not competition model. So we often partner with people that may have been competition on a project for us.
That's really great. I noticed that you have a lot of properties, like you have your latest investment properties. You invest a lot in Texas as well, Texas and Florida and all over. What do you think is hot right now as far as multifamily?
Yeah, so we do have a lot of Texas assets in our portfolio. We just closed on one in October. I think end of October, we closed on a Dallas asset. We are really Florida focused though. The last deal we closed was in December in a suburb of Orlando also. We have a lot of Jacksonville assets as well. So we like Jacksonville. We like Orlando. We actually like Tampa a lot too. We haven't entered that market just yet. We're very, very strategic in how we enter our markets. You won't see us saying, okay, we have a deal in Atlanta and in Louisiana and in California and Orlando. We don't do that. For us, we believe that you have to have very targeted growth and you have to know why you're going into a market. So we like Orlando because of the massive tech boom that's happening there. A lot of companies are moving their headquarters or their regional headquarters to Orlando. So in 2018, we closed on an asset in Jacksonville, and then 2 months later, Wayfair announced it's 1.3 million or a million square feet of warehouse footage that is coming up 2 miles from our asset. So we like knowing that that kind of progress is coming because that brings the tenants who are our tenant in our demographic, right? So the job growth, the stability, Orlando has historically performed well in a downturn market. It's a very diverse community. So there are certain areas that I don't particularly love, but it works for someone else's business model. It just doesn't work for ours. So we're very relentless in our model. We are very disciplined investors. We will walk away. I mean, there are brokers that will tell you we've walked away from $10 million deals over $25,000. And it doesn't seem like a lot, but when we hit our limit, then we just don't go a penny above it, period. Even if it's $100, we won't move.
Yeah, that's important too, because having that sort of self-discipline really can make the difference. And you think, 25 grand on 10 million. But when you know what your limit is and you stick with your limit, then you can be a lot more disciplined on what you do, and you can go for what you really, really want, as opposed to, we kind of had to. I think it's interesting you talked about a downturn market too, because I know there's so much in the news right now. And a lot of our questions are, is real estate investing going to be good, or is multifamily still going to be okay in a downturn market? And my answer is yes, people will always need a place to live. It might be, you might need to change if you're only investing in A properties, going down to C or something different, like what types of properties. But being an investor is typically a smart move still.
Yeah, I agree. I do think we are going to be seeing a downturn here. Enzo's strategy has shifted pretty significantly from where we were even 2 years ago to today. Part of that strategy is we don't leverage up. I know a lot of people are still leveraging to 80, 85%. They're going in with bridge debt. We typically will only leverage to maybe 70, 72% max, maybe 75 on the right project. So we go in with a lot more equity to help protect principal. So that's number one. Number two, we see a lot of investors going in with bridge loans because everything right now is debt cover constrained. And what that means is you can't get a loan big enough to get up to the 75, 80%. So they go in with a private loan or a bridge loan or short-term lending. There's all these different names for it now. But essentially what that is it's a 1 or 2 year ARM type product or a balloon type product. And for me, that's a risk position if you're going in just to leverage up the property, because it means the property can't support a Fannie or Freddie loan as it is. Now, there are plenty of reasons to do this. This is just the most common one that I'm seeing now, which concerns me. So we shy away from that. We do go into bridge or short-term lending if there's a very valid reason and it's not about the leverage or the debt constraint of the property. So, for example, we're looking at an asset right now. It's a reverse condo conversion. So we're taking a bunch of condos and turning it, it's 200 units plus, and we're taking all of those units and turning it into a multifamily. So there's no historical T12, which is required for Freddie Mac or Fannie Mae lending. So they won't lend on it until we have that solid historical. So we'll go in with a bridge to perm solution or some kind of solution like that, where it is short-term or it is bridge, but it's not because we can't get the leverage we need. It's simply because it doesn't fall within the guidelines of Fannie and Freddie.
Right. You already know
Okay.
you just don't have the background to get it. I get it.
Okay. Exactly. And we start stress testing higher. So, we don't stress test vacancy to like 2% anymore. We go up to 10%. We see what it looks like at 12%. We see where our break even is, where we're just protecting principal at that point. So there's just a lot of different changes we made to our modeling in-house to make sure that we're doing our best to protect our investors.
Okay. You talked about demographics quite a bit, and I was curious, what kind of demographics are you looking for when it comes to, the tenants and things like that? What kind of properties is it, and what kind of, types of jobs are you looking for when you're looking at certain properties in the areas?
Yeah, I think that varies from location to location. So someone in Orlando is going to be in a different income demographic than someone in Jacksonville or someone in a suburb of Dallas. So it really varies, but typically we go for those B plus assets. Our general criteria is 80s vintage all the way up to 2000s vintage now. So Princeton Park that we closed last month, it was 35 million, 200 units, and that was, I would say that was a Class B plus asset because it's a 2000 build. So it's a very new property, very nice property, a lot of nice amenities in a really nice area. So that's kind of our ideal property. Of course, we have to kind of pivot a little bit depending on the asset. And we look at our portfolio holistically as well, because most of our investors invest in multiple properties with us. So we're looking at the whole portfolio as a total as well as that individual asset level.
How much say does the investor have in their percentage? So if they come to the table with so much to invest, can they say, okay, I would want at least half to be in maybe C properties and half? Do you allow them to do that, or do they just invest fully? Because I don't know how that would work for that.
Yeah, so what you're talking about is actually a blind fund or a semi-blind fund. Right. And you see that a lot, for example, in mobile home parks, right? They raise a $10 million tranche and then they put that into various mobile home parks. What we do on our end is we do an asset-specific investment. There is talk of us potentially moving to a semi-blind fund model because of our overwhelming demand right now. It also would give us an opportunity to allow our investors to be a little bit more diverse from one investment. But to answer your question, the way it happens is, so for example, on Princeton Park, right, when we had that, we sent it out to our investors. Then they soft committed and they committed $100,000 or whatever that number is, right? That entire $100,000 actually sits on the LP side of Princeton Park. So they don't get a chance to say, okay, I want 50 of it to go to this property and 50 of it to go to that property. It's all in asset-specific investments.
Okay. Yep, that answers my question. Well, we're getting to the end of it. And just so you know, everyone, we're talking to Veena Jetti. And if you want to learn more about Veena and what she's doing, go to Theory, THEORY, PMR. That's P like Peter, M like Mary, R like, or I guess Project Management. What was the
Revolutionize, yes.
Yeah, revolutionize.com. So theorypmr.com. Brian, do you have any? Oh, we never even talked about your Hurricane Harvey stuff.
Oh, well, we can.
Okay. So I was going to ask you a little bit about that. What made you, because you're in California, right?
No, I'm actually in Dallas.
Oh, you're in Dallas. Okay. I
Yeah.
don't know why I thought you were in Cali. I guess it was I I must have been looking at a time
My
zone.
my partner Stephen is in California.
Oh, okay. Well, that's it. Okay, so that came a little bit more close to home for you on why Harvey was the deal. Oh, okay, I get it. Now, Harvey didn't go up there. It kind of like moved over to Beaumont and Louisiana.
Yes. Yeah, so we were actually like a sanctuary city or like a rescue city for Houston. But I actually was coordinating rescue efforts remotely from Dallas in Houston. And so, I was like we had this channel on Zello as like a walkie-talkie app. So we were coordinating like that from here. And so, because there they didn't have power, so it was really difficult for them to coordinate rescue. So we had like a war room that we built at one of my offices, and we had like maps, and then we cordoned it off, and then we sent different rescue teams to different areas of the city.
Well, that's amazing. And thank you for doing that. I was stuck down here in Galveston, and just it is really weird because we saw fish come out of our gutters here. So it was so flooded.
I'm sure.
And I'm in the actual city part of Galveston, so I'm like pretty high. And you're looking out in your backyard, you can see like minnows and then bigger fish. And then you realize that's the Gulf. And then when it dawned on me that now I'm just part of the ocean now. My house is literally part of the ocean. And I kind of like, because it wasn't supposed to be like that. Normally we're good with rain. It'll run off. But because of the high tide and all that, it was not good. It was not good.
It was crazy. It was definitely a difficult time for a lot of people. And, Houston's still rebuilding, even though that was 2017.
I still have a power issue in part of my house from that because of insurance. And there's so many other people that had to get
immediate relief.
Immediate relief. And then the massive amount of the area, when you're thinking about, it was like multi-state, of people who just had issues.
It was huge.
Yeah, it's massive. It's just massive. Okay, Brian, did you have any ending questions for Miss Veena?
Well, I just wanted to thank you for being here, and any kind of parting words of wisdom you'd like to, give to our listeners of getting started, or anything that you've learned over your extensive career in real estate.
Oh, gosh. Okay. Well, first, thank you for having me. This has been a lot of fun. Secondly, so parting words of wisdom. Everyone asks me this, and I should just have something prepared, but I like to ad-lib everything in my whole entire life. So I would say don't get stuck in analysis paralysis. It is very difficult to get out of it, and it's very tough to make that first leap, and you're going to make mistakes, and you're going to maybe lose money along the way. Like, we've all been there and we've all done that, but you have to jump in, roll up your sleeves. Like Jennifer said earlier, this isn't easy. It's not easy to do this. It's definitely going to be hard work, but it's definitely worth the reward at the end of it. So don't get stuck in analysis paralysis, and find the right partner and jump.
Awesome.
Well, that is great advice. Well, thank you, everybody, for joining us today on Leafy Podcast with Veena Jetti. Again, if you want to visit her, go to Theory, THEORY, PMR.com, theorypmr.com, or you can go to EnzoMultifamily.com. And we will have all the links, as we always do, at the end of the show, at the show notes. Tammy will put them all in, and any links that she wants to give us will be there as well. And you can find us on iTunes, iHeartRadio, Google, Stitcher, everywhere, wherever you're already listening to us as it is right now. So you guys have a wonderful week. It is 2020. So let's have a good one, guys. Bye-bye.
All right. Thanks.
Thank you.
Attention real estate investors and entrepreneurs. Did you know that real estate investors are a primary target for lawsuits? According to the National Survey of the Court data, 25% of Americans risk being sued in their lifetime. However, if you are a real estate investor, you have a 95% chance of being sued in the next 20 years. Leafy Legal Services helps you protect your assets and strategically grow your business and wealth. Leafy Legal Services are experts at the Series LLC and Delaware Statutory Trust trust, two of the newest and most ideal legal structures for real estate investors. Leafy Legal Services have the most personalized and affordable solutions for setting up LLCs. Property owners are always at risk when it comes to their assets. Anonymity is so important. If you own just a rental house and you own your home, you have to protect yourself and your properties from any potential legal issues. Leafy Legal Services have the right solutions to make sure you are happy and feel secure. They offer cost-effective documentation that suits their clients' needs. For a free consultation and ebook, visit leafylegalservices.com. They are waiting to hear from you. leafylegalservices.com.
Follow us on Facebook, Twitter, and Instagram.
Don't wait. Take action now. LeafyLegalServices.com. Protect your assets, grow your business, and manage your wealth.